Well, here we go again, Kenny Gatliff. Thanks for joining. So, investment manager, portfolio manager extraordinaire. I'm Dan Pallison, wealth manager, financial psychologist. So, Kenny, always good to see you, man.
Yeah, thanks for having me back on. It's always fun.
Okay, Kenny. So this is our third recorded conversation. We've talked about like the S&P and other asset classes being at all-time highs, and then in our second conversation we talked about like what are these different asset classes. So the natural progression, what I'd like to dive into today is this idea of asset location. So in our
Mhm.
last conversation we were talking about asset allocation, like what are the different types of asset classes, how do we want them in a portfolio, the different ratios of each. So that's asset allocation. Can you talk a little bit about what asset location is?
Yeah, sure. It's honestly it's one of those things that isn't talked about as much in investing, especially, for just the layman. You don't really hear that term thrown around a whole lot. And I think most people generally get at least some idea of asset allocation. But asset allocation is not the asset classes or sectors that you're invested in, but it's how you have your assets arranged between your various accounts. And I know that's not a great explanation, so I'll go in a little more detail. And so that's
Please.
basically saying, you're going to have stocks, you're going to have bonds, you're going to have cash, and you have to decide which account types you're going to keep those different asset types in. And so, for an example, if you have all of your equities or all of your stocks in an IRA and all of your bonds in a Roth IRA, and sorry if I'm going ahead of what your next question might have been,
Please. No,
but
that's great.
when those accounts grow over time, especially if you have a long time horizon, well, at the end of that, you should hopefully have a substantial amount of growth in those. And what I think most people do know is that those Roth accounts, well, they come out tax free, whereas IRAs, any growth in the IRA comes out taxed at ordinary income. And so, because of that, it actually is very advantageous to have your more highly growth oriented assets within that Roth account. And the reason being is, that in the Roth, your growth is essentially tax free. So if you have bonds returning, I'm just making up numbers here. If you've got bonds returning 4% a year for the next 20, 30 years, and then you've got stocks returning 10% a year for the next 20 or 30 years, well, that's a substantial difference. And if you're paying taxes on the stock part and not the bond part, versus if you flip that, that actually makes a substantial difference on your net after tax, what actually comes into your bank account when you start taking distributions. So it's
Yeah.
a non-trivial decision as to how to allocate these assets in the different, locations, as you're
Yeah.
saying.
Yeah. No, that's great. So it's about getting the right types of assets, the right investments in the right account. So let's just say, for example, average investor has a traditional IRA, a Roth IRA, and then like a brokerage account or a joint
Mhm.
account or a trust account, but it's not a qualified retirement account. So, and then they've got mixtures of, or they need or want mixtures of stocks and bonds. You've already touched on this, but what types of assets would you prefer to have in a Roth, in a traditional IRA, and then maybe in that taxable brokerage account?
Yeah, no, it's definitely a good question, and it's an important answer. And the way we kind of look at it, there's different tiers of how important it is. And the first thing that we want to avoid is having any bonds in a Roth IRA if possible, because again, those are going to be the lowest growth instrument. And because that growth is tax free, you're just giving up after tax return if you have any bonds in a Roth IRA and then equities in any other account outside of a Roth IRA. So that's kind of step one, is get your bonds out of the Roth. And then step two would be, if you can, get your bonds out of that brokerage account, that non-qualified account, because bond interest is taxed at ordinary income, whereas, stocks, they do pay dividends. So you do pay kind of taxes along the way.
Mhm.
But generally, depending on the interest rate environment, dividend yield is going to be less than interest rate coupon payments, and you're going to pay it at a lower rate. So dividends come out at just the capital gains rate, which is 15%, and up to that 23% if you're over a certain threshold. But for a lot of especially high earners, that's going to be less than the ordinary income that is going to be generated by bond income. Now, obviously, there's always caveats if you have municipal bonds or if you're in a different tax bracket. So that's going to be looked at individually. But
Yeah.
as a general rule of thumb, you generally try to avoid that taxable bond income in a non-qualified account.
Yeah. Yeah. Well, and you're the investment guru, and that's why I like having these conversations with you. But I can actually add a little bit to this conversation today. I'm a certified financial planner, and tax planning is a component of what I've been trained in and certified in. And so I know from a tax standpoint, having like volatile equities in a brokerage account, there's some value to that as well, as opposed to bonds that typically are more stable and steady over time. But volatility, by the way, doesn't just mean downward volatility. It could mean upwards as well. It's just assets moving up and down. But anytime positions are down in value in a brokerage account or a trust account, we can sell those, purchase something else that's similar. So we're not changing the makeup of the portfolio, but we're capturing some losses, some capital gains, or some capital losses on paper, and then using those at the end of the year to either offset capital gains or lower your taxable income. So that volatility, if it's going to happen anyway, it's kind of nice to see that in like a trust account or a brokerage account, as opposed to an IRA, because everything is tax deferred in an IRA.
Yeah, so, that's good. Yeah, and I know this can be a little bit of an abstract concept, and I actually did write a paper or an article on this that, Dan, if you can reference if anyone's interested, but it kind of throws some numbers along with this and shows, with data how important this decision is based on a pretty normal circumstance that we see with a lot of clients. So I'll just kind of reference that and throw that out there for anyone that's interested in doing a little deeper dive. But all that to say is, what you just mentioned and kind of what we talked about so far, it's, as I said before, it's not trivial difference in, your after-tax return. So this is an important conversation to have.
Yeah. Okay. Well, and as we approach our 10-minute mark, which, by the way, for the listener, Kenny and I commit to keep these conversations within 10 minutes. So, high level, we've got asset allocation, stocks versus bonds. How aggressive, how balanced, how conservative do you want your investment portfolio to be? But then there's asset location, making sure the right types of investments, your stocks or your bonds or some of the other classes, are in the right accounts. One thing that I'll touch on is this idea of Roth conversions. And so we've been talking about Roth accounts and what types of investments should go in Roth accounts. Ideally, those investments that are earmarked for long-term growth or have the best potential to grow over time, because that growth is not ever taxed again once it's in the Roth. But I've had a lot of clients ask me about Roth conversions. So I'll speak to this kind of high level. Roth conversions are moving assets from like a traditional qualified retirement account, so like an IRA, moving it into an Roth IRA. So moving money from your traditional IRA to the Roth. This is not a tax eliminating strategy. So I want to be really clear about that. But what we're doing when we do Roth conversions is we're looking at lowering your tax bill over your lifetime, because we might be increasing your tax liability in the year we do a Roth conversion, because we're actually, accelerating moving money out of an IRA to put it into the Roth IRA. So it might be increasing your tax bill this year, but over your lifetime, we're trying to reduce your tax bill, because all the growth that'll happen will be in that Roth account. So again, for all of you that I work with, we'll be addressing Roth conversions. Kenny, we've got about a minute left. We're here. Selection Sunday was yesterday. They just released the NCAA brackets. I think every year that you and I are in some kind of a bracket challenge, you walk away with some money. You're one of the top, I guess, basketball team pickers that I've ever met. What's one tip for those out there that are filling out their brackets? What's like a Kenny's guarantee NCAA March Madness bracket tip?
So I'll actually say this is the exact opposite as my investing strategy. So investing, you don't want to take high risk. You don't need to come in first place. If you kind of are in the middle of the pack and just get market returns, you do well. In picking college basketball pools or, filling out your bracket, it's the exact opposite. If you kind of the Ricky Bobby quote, if you're the second place is the first loser. If you ain't first, you're last. And so you do have to take big risks. And so that's why, when picking the bracket, taking calculated risk is my strategy. But again, it's the exact opposite of what I recommend for investing. So, don't just pull out a clip of this and use that to say what my investing strategy is. I feel like I can get in trouble for that. But basketball picking, yes, take big risks.
We got 3 seconds left, Kenny. Thanks again. See you later.
All right. Thanks, Dan. Bye.